There's a world out there, it's a digital maze where dollars move in mysterious ways. Complex systems, rules, and regulations. The payments professor sparks revelations. No need to fear the Fed now.
Hey, everybody. This is part two of the international conversation that I've had going on with my friends Paul and Andrew, and of course, Ted Hoff from Fintech Confidential. Paul and Andrew have been sharing with us what they are seeing happening on the global aspect, especially what's happening in the Eurozone when it comes to electronic payments. I'm not going to keep rambling on. Let's just get back to the conversation.
I think if I was to switch gears a little bit with you, Kevin, I want to talk about going digital.
Oh, good, because I want to know about the digital euro. But where are you going digital? That's what you got to tell me, Paul.
Well, so here's the thing, right? There are, I can't remember exactly now. Is it 90,000 crypto coins that are out there? You know,
you might be lowballing it.
Yeah,
You're right at some point, right? Every day there seems to be a new meme coin or other alternative coin. I refuse to use the other term for them, but
here's the thing. I think so. You know, there are 7% of those are stable coins, all tied to the dollar. I don't think anything's not tied to the dollar in any of those stable coins. Certainly not tied to the euro, as far as I can find out. What I would say, though, is unlike in the US, the EU is very interested and will have a digital euro, a CBDC. Now, we could argue what it's for, what it's replacing, its benefits and all those good things. But the first part of what I was, alluding to at the beginning, I think it's almost inevitable that we will within, is it 2 years now or 18 months? Time moves pretty fast, Andrew. Keep me honest here, but it's pretty soon. There will be a digital euro. And I think that will be the first major region to have its own CBDC. I mean, there are other digital, CBDCs out there. But I don't see the interest in Europe other than, as an investment tool, as an asset for crypto coins in Europe. I see very little appetite for that.
Well, and what's really interesting there, Paul, is that the digital euro, I mean, it's interesting that you use the word a digital asset or an investment platform. I mean, it's really just, it's not supposed to fluctuate. It is a euro, and it's going to stay a euro. Now, whether the euro appreciates or not is a different story, but the digital asset itself will be tied to the euro. And there's rules in place to how many digital euros you're allowed to have as an individual, regardless of the number of wallets you have. So they don't want you having 30 different accounts, each of them with is the limit, I think, 2,000 euros. So right, so there's 3,000. Okay, yeah, I wasn't sure, but the point is, how are these wallets going to talk to each other? What is that going to mean from a competition perspective? And I have to say, living in Germany, where cash is still something around 40% of all payments. I have trouble going to restaurants and paying with a card, let alone a digital euro. If my Saturday market, the farmers market I go to, if they could accept card, I would be thrilled. I think it's going to be 10 more years before that happens. So, maybe I'm wrong. Maybe they will go straight to the digital euro in a couple of years and I won't have to worry about it anymore. But I'm skeptical. I mean, I don't mean this in a bad way. Germans, I would say, are generally conservative when it comes to these things. They're not early adopters. They're not pushing the bar forward. That's what the Swedes are for. Or the Dutch, they do that stuff. The Germans kind of sit back and wait.
Statement across all of Europe.
Yeah, well, I mean, I think Sweden's at like 130 real-time payments per capita. I think Germany's around 5. It's
that bounces out the average for us.
There you go. I mean, so it's, there are positive things and negative things, right? But yeah.
But isn't the idea around that to relieve a lot of the things that we started out talking about, the the variations between all the different separate protocols, all the different variations of the diligence process, all the variations, all the I could go through the list, right? But that's the idea, is to eliminate that. But then don't you start to make that more and more difficult as you start to put restrictions on how many wallets you can have, how much you can have in those wallets, what wallets can talk to what wallets. Like those are, it almost is self-defeating at that point, it seems.
I think that I think the I think it's the body politic now. If the digital euro is commissioned, minted, for want of a better phrase, in Europe, the rules are in Europe, Europe controls it. Maybe that's why it'll live. I think the more interesting question is a little bit to what Andrew was, scratching the itch of, which is legal tender. And it may surprise you to know that not every country in Europe believes that legal tender is the same thing. In fact, as far as I can tell, no country agrees with any other country what legal tender actually means. However, the EU would like the digital euro to be legal tender, which effectively means you have to accept it. Now, we shall see whether that becomes really real. But if you can imagine, to Andrew's point, going to the farmers market in Romania, which is what, 80% cash, something. It's a huge amount. And you say, oh no, I've got this little wallet, and I want to pay with my digital euros. And that feels a long way away. But nevertheless, you can see that that's coming from a political agenda as well as a technology agenda to fixing a digital question. And we'll see whether that's really going to happen. I suspect it will happen. Whether it'll be significant is I guess another point.
See, and what you're right, because what we're seeing here is I'm hearing more stablecoin, a digital asset that is pegged to the US dollar. But CBDC is not going to happen. We're definitely hearing no, there will be no CBDC. But stablecoin galore is what suddenly, since the new administration has taken place, at least that's what we're hearing a lot more of happening. And if you really get down to it, and let's say take the layman off the street, they don't understand the difference. And they're not really going to see the big difference in the details, the minutia of what makes the two different. So, I mean, it gets confusing sometimes. I mean, I'm like you, Andrew. Why can't we just make it where make it simple where I can just use my card?
I think there are two issues with that, and they are both, well, they are effectively the same. Actually, thinking about it, it's politics. If a digital currency, a digital coin is tied to the dollar, the rules of the dollar changes. That's out of European control. If the schemes from the card networks change their rules, it's out of European control. So effectively, I think the driver is that of a European sovereignty more than, crypto or anything else. So I think that the reason that it's likely to be pushed forward is that it creates the semblance of sovereignty and being under the control of European management. That's, I'm not saying it's good or it's right or whatever. I'm just saying that is the direction of travel at the moment.
And that's been an unofficial goal of the Commission for a long time, right? Is to make sure that Europe is independent of foreign tech and foreign schemes, so that payments in Europe are not threatened from outside players, which, I can understand that goal. And I think what's also interesting, if you look at the US case, I don't remember when it was, maybe 2 years ago, a bunch of senators came out and I'll be generous and say they were misinforming the public. They weren't, I won't say they were straight out lying, but they were spreading falsehoods about what the US dollar or the digital dollar would be and what it would mean. And they kind of killed the debate under false pretenses. I don't think the digital dollar was about tracking people and preventing them from buying guns. I mean, that's what people were saying. That was never the purpose of a digital dollar. Whether you agree with the digital dollar or not, I think we should have the debate on the merits of the debate rather than on false pretenses, and that for me is really upsetting. And I think the current administration, judging on their high level views on regulation, I think sometimes regulation is a good thing. I think we tend to, in finance and payments specifically, often will say, oh, the regulation is such a burden. But in many ways, regulation can create a framework, right? I think there are very few people who would disagree that cars should meet a certain level of safety standards before they get on their freeway. They protect the people in the car and they protect the people in the cars around that car. That's a good thing. Do we need to have regulation that tells you the exact composition of a windshield and the thickness? I mean, maybe there needs to be a certain minimum that, if they want to add extra, who cares? I mean, I don't mean to talk about cars only, but I think generally speaking, when regulation lays the foundation for innovation and progress and safety, that's a good thing. When it becomes burdensome and doesn't actually fulfill any goals, for example, my example with the IBAN discrimination, right? When we have a piece of legislation that prevents something but no way of enforcing it, and yet it's been on the books for well over a decade, and yet we still have it. You then have to wonder, okay, well, what are we doing wrong? What do we need to change in order to make this effective? So, I guess I just don't want us to paint all regulation with the same brush of saying all regulation is bad and therefore we don't need any of it. So let's just get rid of it. It's unfortunately the world is not black and white. It's lots and lots of shades of gray.
Well, Andrew, I actually love your analogy because I can relate it to F1. I'm a huge race fan, and I look at F1 needs regulation to make sure that the cars are safe, that on the track the cars are safe, that they are competitive to a certain level so that, we have fair racing. But I also don't think they need to be where they're going right now and saying, you can only say certain things on the radio. Get out of there. There's nothing, there's no reason to get involved in the radio talk. Like there's certain areas, yes, we need to go into regulation. And then there's certain areas that maybe we don't need so much. And it's interesting you bring up regulation because that's one of the topics I wanted to have some discussion with. I saw a headline today that the UK government is looking at scraping payment system regulators and folding them into the Financial Conduct Authority. And I'm wondering if that's something similar to I don't know if you've seen where we're having a lot of changes with the CFPB over here, which was kind of a surprise, but not a surprise at the same time. So are those types of changes maybe to make it better for regulation because what I've seen here in the US is we have too many cooks in the kitchen. I mean, regulation is good, is necessary, but we get conflict because we've got too many different areas that start opposing each other, and it just makes it difficult at some points in time to keep up with all of the different regulatory bodies. So are you talking from the aspect of maybe we do need regulation, but we need it to be more consolidated of where it's coming from and more consistent on what's happening?
I think the UK, I was on the PSR for 6 years. And I worked with the guys trying to get some of this stuff out. And their active conversation was that they wanted fintechs to have headroom. They wanted them to have a sandbox, which we actually created for them. And they wanted them to push some of the barriers. Obviously, they didn't want them to crash. They didn't want to do bad things, but they wanted to push. And then they said, well, okay, enough's enough. Now you've got to join the real world. And effectively, that's what's happened. They're saying, hey, if it smells like a bank and it acts like a bank and it moves money from A to B, you're kind of a bank and you're doing payments, so we're going to regulate you. Or more to the point, you have to adhere to the rules that your competitors do, whether that's a Barclays or a Lloyds or, whatever it is. And effectively, that's what's going on now. They're saying, enough, you're doing payments. You're in the camp.
What's interesting there is when you look at the United States, because you have the federal level and then you have, the various states. A couple of years ago, there was the argument between the state of New York and the federal level about who had the right to regulate a certain type of license, right? And it went back and forth and back and forth. And this is the kind of thing where I think to myself, okay, what are we really accomplishing by having this? These are two agencies that are essentially having a turf war. In the end, as a consumer, do I really care if it's the state of New York or the feds? Well, no. In the end, what I care about is my product safe? Am I able to access my product? Are the rules being followed by the service provider? I don't care if the feds are doing it or the states are doing it. And personally, I'm a fan of as little regulation as possible while still solving the problems that we have. Whether it's, again, at the state level or the federal level is a different issue. That said, when you have 50 different states and you have, I say this from the European perspective, I've tried helping a couple fintechs move into the US market. And it's a nightmare. It's a nightmare because, first of all, I'm not a lawyer. And second of all, I had to explain to them, guys, there's a federal government, then there are 50 state governments. And depending on the types of services you're offering and where you're offering them, that means you have a lot of different regulators. And they just asked me, like, come on, this cannot be true. And I said, unfortunately, it is true. You think Europe can be bad, the US can be just as bad sometimes. And so, in the end, I'm sure it provides a lot of work for lawyers. I'm not sure how much it really adds to the safety. But, it's kind of like textbooks, right? Like, basically California and Texas kind of state the rules on textbooks on how that ends up happening because, Kansas and Missouri and Rhode Island don't have markets large enough for the big book providers to write textbooks specifically for the Rhode Island education market. So they end up just kind of doing what either California or Texas does, right? So there's almost a market for textbooks in that sense. And I would like to see something similar with let's say, financial services regulations where there's a certain common denominator that ends up being used by a lot of the states, because I think 50 states plus a federal government, it's just too much. And you're not actually adding value by creating these hurdles. All you're doing is protecting certain state markets.
So over the weekend, yes, I'm also on LinkedIn over the weekend, Andrew. So you're not the only one.
That's good.
But also I'm in a number of other groups where we have these text threads that are just crazy, and one of the questions was, hey, we need to do a change control. How long does that take? And speaking of the US, how long does that take to get that across all of our money transmittal pieces through all of the states? And the fun answer was, it depends. Because it depended on what kind of change control is it, what services do you offer, what states are you offering it in. If you're offering it in all 50 states, yeah, some of them you just have to send a notice saying, hey, we did this. Some you have to say, hey, we did this and this is why. And then others you have to go through the entire diligence process all over again and have bonds and insurance and everything reissued. So it's for a period of time that group is going to be holding 2 sets of insurance policies, 2 sets of bonds, 2 sets of everything until everybody has signed off on it. So it's really interesting to see. And there's little, I'm gonna side, there's little reason for it to be that way. I mean, I've done a number of the money transmitter licenses across the US. And, of course, we always start with California and New York because they take forever and are extremely difficult to work with on average. But But yeah, just the whole idea of just to change, do a change control, taking just about as long as getting the license itself was kind of funny.
And essentially it's a tax, right? I mean, in the end, it's a cost for the organization trying to provide a service, and it just raises the bar to making changes that could actually help end users, whether they're consumers or businesses. So essentially, regulation is just is an indirect tax on the business at that end.
And then if they don't like it, we get regulation through enforcement. So
And this is why I try to stick with just the banks or credit unions, because then I can just go in and ask a couple of questions. Are you a bank or a credit union? Are you state? Are you regional? Or are you national? And then based on giving me those answers, then I know which associations, and it is plural, which associations and which regulations you are then going to have to answer to. And I can start building you a spreadsheet. And yes, it is going to be a spreadsheet of all the different things you're going to have to start checking the boxes off for. And that's called job security for me.
And you're not even a lawyer, Kevin.
I'm not.
It's interesting, isn't it, when you know, if you were to have that conversation from, a European point of view, and you were saying, where do you want to launch your new bank? You'd be, probably looking at somewhere like Malta, Lithuania. You probably don't want to be in France or Germany, and you can make choices, about these things. And you say, well, I'm just going to do euros anyway. So what does it matter? And well, some of these countries want you to be there. Some of the countries make it easier to process. Some of the countries are just slower, for want of a better phrase.
So I'll give you a really good example. There's a European bank that I've helped move into around 35 markets around the world, some of them within the Eurozone, some of them outside the Eurozone. And in one specific market that I'm helping them move into now, there are specific regulations as to the number of people that have to be in the branch, what languages they have to speak, how far away they are able to be from the branch in terms of their physical location. Yeah. And the local ACH requires them to have specific certifications. Now, maybe it has to do with their tech platform. I'm not really sure. It wasn't clear from the rules, but it was very specific. It has to be 3. They have to speak this language. They have to be located in the market. And they had to have certain qualifications, right? And there are other.
Didn't happen to be talking about like Quebec and Canada at all, could you?
No, this is in Europe.
Okay, because there are very similar rules for any business, not just financial, but any business in Quebec and Canada, and in Montreal. So when you get that specific, almost everything you just mentioned, I'm like, yep, and you get almost all the way through it, and that's where my mind went, is because it's even at a province level in Canada. So
yeah,
it can be fun.
And again, this is Europe, so you would think there'd be somewhat similar regulations, but every single market I've looked at, there are certain rules around how to passport a license. That's all the same. But when it comes to what is the definition of a bank branch, what does that mean in terms of the staff involved? What does it mean in terms of the level of seniority? That's different in every single market. And there's, like I said, a lot of markets in Europe.
So I've been told, and I have a little bit of firsthand experience with European financial institutions, but I want to ask you guys as the experts here. So I've been told that because you mentioned Malta, Lithuania, of course I hear Cyprus frequently as well.
Yeah.
Like, for those who have little or no experience, like what is the difference between going to one of those 3 countries versus going to London?
Let me give you, Andrew, I'll have a stab at this. Perhaps you can perhaps be a little bit more, bit of an adult about it. I would say if you want to go to Cyprus or Malta, think more Vegas and what goes on in Vegas. And if you think if you think of London, just think of London. It's kind of like, and that's kind of the way it is, really. And so all these countries are sort of equal, but they kind of do different things.
I'll expand upon that, and I won't mention the countries, but there's a couple countries where the people there at the central bank have just been super responsive. I write them an email, and 2 hours later, I get a response, and it'll either be like, "Here are the questions you asked. Here's a detailed answer with like footnotes." And there's another central bank who I've been trying to get a hold of for 3 months, and I call them, they answer, and I ask about the email I sent, and then they go find the person, and they say, "Okay, it'll be done in 2 days." And 3 weeks later, I call again, and it's just the level of responsiveness even is very, very different. And my client has told me, yeah, this country over here, we had a fantastic experience with them. They met us at the airport. They took us in. They helped us get our application finished. And then when we called this other market, it was birds chirping. It was silence. There was nothing going on. No responsiveness. No willingness to help out. And these were both countries. All three of these markets I'm thinking of are all in Europe, and it's just yeah, what can I say? The level of difference is very high. And then when it comes to let's say the level of activeness of the central banks when it comes to regulatory matters, that's also very different. A banking license is supposedly a banking license no matter where it comes from in Europe, but I think any bank or fintech would tell you certain regulators are tougher than others, and that's what leads to certain markets dominating in terms of registered fintechs for, say, EMI licenses. It's not all regulators are the same, even if they have the same legal weight.
Yeah, I think another way of looking at it is some of these countries, a bit like you do in America, you want to encourage people to come so they pay the taxes locally. Well, for some of these small countries, having lots of banks, lots of transactions going through them. It's just compute power. So great. Whereas, if you want to, there'll come a time not so far away, I suspect, that a major German bank won't want to accept transactions quite so easily from some of the more modern or newer countries that have set themselves up to be financial institution friendly, and that's because their diligence isn't the same.
Yeah, although I think the German regulator BaFin, they really got egg on their face with Wirecard, right? I mean, I know I shouldn't bring that up.
I said that one, should I? Sorry.
Yeah, but it's one of those things, right? That the Germans had the reputation for a long time as, yeah, we're really tough, but we're good at our job. And then Wirecard happened, and you're like, uh-oh, we messed up big time there. And if you ever get a chance to watch,
be really tough now. That's the piece where I struggle with regulatory environments in general, and I've been very open about this. Like, are we regulating for regulatory sake? Are we making it harder so that we can build our fiefdoms of more people to go do more diligence so that we feel more important? And like, it feels like it's a never ending cycle of more without understanding the overall arching impacts and what is it we're really trying to accomplish with the regulation. Is it really to increase trust and safety, or is it to prove that we're right? And like, that's the piece that I struggle to see. Is too often it feels like we're trying to prove that we're right and everybody else is wrong, and that's where I struggle a lot with regulation. And I'm not talking just about financial. There are tons of other areas that we have those things in place too, that if it was truly about trust and safety, I think we'd be a lot better off.
I could write a book about all of the German regulations that drive me crazy. And when you've renovated your house or your apartment, it's a whole new level of meaningless and pointless bureaucracy. Kevin, I'll have to tell you this over a beer sometime or dinner. Maybe tomorrow in Dallas.
I was going to say, I'm going to see you soon. And guys, we are actually getting to the top of the hour, and I would probably read that book. And to really close this out, this is how I would love to close this out, especially after you brought up Wirecard, because this is a safe space. I love to hear predictions, and I would like to hear your prediction on what do you think is going to be the next really big issue? Whether it's in the U.S., whether it's in Eurozone, what do you think is going to be the next big issue we're going to have to be dealing with that's coming? Something that's happening down the line. Maybe it's with the digital euro. Maybe it's with fraud. Maybe it's with regulation. It's always something new. But what is it that you think is that's boiling, that's going to happen, that maybe it's the unseen, that's out there right now in the industry that we should be paying attention to, that's right around the corner? Because like for me, one of my big concerns is we can't get rid of the CFPB. We've got to have something comparable at least, because for the US, the CFPB is consumer protection. Somebody's got to have oversight on Regulation E. My opinion is the CFPB has done too much, has overstepped their bounds, does need to be pulled back as far as what they're doing, maybe, slapped around a little and put back in their place to do their job to where it's actual consumer protection. But we do need consumer protection. Otherwise, it's going to create a bigger issue, and that's going to create bigger problems. But what would you say is the next big issue that's happening in payments that we need to be paying attention to, guys? Who'd like to go first?
I guess I'll go. I think fraud is still just going to be a really big issue. And I say that because adoption in the United States is still relatively low when compared to global standards. So I think, unfortunately, fraud is going to continue to grow in the US. But maybe I'll go out on a limb and I'll say what I'm really concerned about actually is a political fight over sovereignty, as Paul was saying earlier with let's say the big North American, let's say fintechs, if we want to call them that, and their role in European payments. I'm hoping it doesn't happen. I'm not saying it will, but that's something that scares me. Is what happens if someone gets upset and says, you know what, Mr. Card Scheme, we're cutting off Europe. We're tired of them, and that's something that worries me.
Wow.
I think I think that we'll get pretty close to that soon, and I hope that it doesn't cross the line, I have to say, but I think that's effectively what I see coming. So so the other one that I'd say is I worry about fraud a lot. I worry about people saying, "Oh, well, don't worry about fraud. I've got AI." It's like my AI is better than your AI. Really, let me tell you, the bad guy's AI is better than any of you guys. And I think my fear is that we think we know what fraud is right now. I don't think we've scratched the surface of it. And I listened to a conference in late summer where two extraordinarily well-known household banks basically said, we're investing in AI to fix this. And I'm thinking, oh boy, if you don't think the bad guy's AI is going to be better than yours, you're really lost. So I think fraud, knowing who you are, and therefore getting into digital identity pretty soon, is a hop, skip, and a jump away, I think.
I agree, Paul. Ted, take us home.
Well, you guys both hit on some very, very big things. I think we're going to see. I'm gonna hit on fraud for first one because I'm just gonna finish that loop because in my mind I wanted to finish it. But fraud, we're gonna see more advanced versions of social engineering, even beyond what we've heard and seen about today, which is going to bring in the need for digital identities, as Paul mentioned. But I think it's also going to increase the velocity of non-sovereign digital currencies and digital assets, aka stable coins. I think that's going to increase it greatly because we're going to be able to tie the digital identity to it and a whole bunch of contracts on top of it. That I see that accelerating greatly, even though the one that's getting tossed out frequently, I will call them out by name, Tether right now is getting told no by just about everybody, for good reason, honestly, at this point. But I think we're going to see that stablecoin piece happen, especially in the business to business side of the house. And then once everybody gets comfortable there, then we'll see a flood over into the consumer side.
All right. Well, gentlemen, I want to thank you all for taking the time out to be here today. This has been enlightening, to say the least. It's been a wonderful conversation. Andrew, Ted, Paul, everybody paying attention, please go subscribe to Fintech Confidential. Go check out Bite Size Payments. Andrew Gomez, he's out there on LinkedIn. He's checking it all weekend long. He let you know that. So if you want to go subscribe, that's where you can go follow him, send him messages all weekend long, and I'm sure he'll be answering you. But other than that, this is the part where I just got to say, class dismissed.
There's a world out there, it's a digital maze where dollars move in mysterious ways. Complex systems, rules, and regulations. The payments professor sparks revelations. No